Net income is the final measure of profitability on the income statement. It represents income after all expenses have been paid out. It's also called the bottom line because it is the bottom line on the income statement. It's called net earnings as well and net profit. So those terms are all used interchangeably. Net income, net earnings, net profit. And here you see for Apple that they've reported net income of $37 billion on sales of $170 billion. Shares outstanding represent the number of shares of common stock outstanding. One share of common stock represents 1 unit of ownership for a public company. For private and public companies alike, shares are held by company founders, investors, management, and other employees of the firm. Owners of these shares, we call them shareholders, are generally entitled to vote on the selection of directors and other important matters in proportion with the number of shares they own. The more shares they own, the more of a vote they have. They also have a right to receive dividends per share. So the more shares you have, the more dividends you're going to receive. Shares that have been issued but subsequently repurchased by the company are called treasury shares or treasury stock, and they are no longer outstanding. We're going to discuss treasury stock, why a company may choose to repurchase its shares at a later point. But for now, just understand the basic equation that the shares outstanding that a company has is a function of all the shares it's ever issued minus all the shares it's ever bought back and effectively retired, taken out of circulation. Now, with shares outstanding, perhaps the most interesting analytical question is, do you look at basic shares or do you look at diluted shares? There are really two ways to think about who is a shareholder. And if you think about a shareholder as simply only the people that currently hold actual shares, well, then the basic share count is what captures that. The basic share count represents only the actual shareholders. And in fact, you can always see for any company, you can look at the front cover of a company's 10K. And as we saw in a prior video, we went to the front cover of one of our company's 10Ks, I believe it was Walmart, and we saw that they had a certain number of shares outstanding. That represents basic shares. But a more important and a more useful concept in terms of how to think about shares outstanding is diluted shares outstanding. And diluted shares outstanding includes the impact of potentially dilutive securities that expand the share base. Things like stock options, preferred shares. These are securities that the holders of those securities can convert into common stock, sometimes at any moment. And so from a real economic standpoint, these are truly potential shareholders, and we have to factor them in when we think about, what is our fractional ownership of this entity if we're investors and we're trying to figure out what slice of the pie do we have. Certainly you want to consider the fact that there are all these people in the wings that they're not necessarily common shareholders, but at any moment they could be common shareholders. You certainly want to contemplate and include those folks in the share count if you're analyzing a business. And now that we've introduced the concept of shares outstanding, we can introduce the concept of earnings per share. I suspect you've all heard of the term earnings per share. A very common way that investors analyze company profits is not by looking at them in absolute terms, but by dividing net income by the shares outstanding. And this metric is called earnings per share, or EPS. EPS measures how much of the total current period profits belong to each shareholder. As we talked about, there are two ways to think about who's a shareholder, and that leads to two different ways to calculate EPS. There's basic EPS, which looks at net income and divides it by the actual shareholders, the basic shares outstanding. And then there's the more important and more broadly used diluted EPS, which looks at net income but divides it by the diluted shares outstanding, the shares that also factor in option holders, convertible preferred shareholders, convertible preferred debt holders, and on and on. The one other nuance of earnings per share that ends up being a bit of a challenge when you get into financial modeling and things of that nature is that earnings per share has to be presented on a weighted average share basis. So since the total number of shares outstanding fluctuates as shares from options and preferreds may be converted during a period, or the company is repurchasing shares throughout a period, companies usually show the number of shares outstanding on the income statement as a weighted average of the amount of shares outstanding during the period of the income statement. So if we're identifying that Apple has generated net income of $37 billion in 2013, that's what Apple had reported, well, then the share count that we divide by to get to earnings per share should actually reflect a weighted average of the number of shares that have been outstanding during the period. You don't want to capture the year ending share count, because if the company repurchased a whole lot of shares during the period, well, then you're going to really skew what is the true earnings per share during the period. So let's take a look at, again, back to that Apple income statement. Since diluted shares include all these other securities, diluted EPS will almost always be smaller than basic EPS. Interestingly enough, there are situations which diluted EPS is bigger than EPS theoretically, and that's called anti-dilution. But we're not going to get into that. What we're going to focus on is the vast majority of the time where you have something where diluted EPS is going to be smaller than basic EPS, simply because the diluted share count, and you see that here, is almost always bigger than the basic share count. Diluted EPS is far and away the favored approach of looking at EPS as opposed to basic EPS, because it's more real. And you see the companies report both basic and diluted EPS, but whenever you hear, on CNBC or in financial news, companies talking about beating earnings per share expectations or whatever, they're almost always, unless they're specifically saying otherwise, they're almost always referring to the diluted share count, just because it's the one that analysts spend more time thinking about. So net income represents the profits that a company generates during a period. An important question for CFOs is what to do with those profits. One option is to make distributions to shareholders via dividends. And dividends represent a portion of a company's net income that is returned to shareholders, typically on a quarterly basis in the form of cash. Now, dividend policy is set by the board of directors. It's reviewed regularly, and it's disclosed in the company's financial statements. Now, the thing to keep in mind with dividends is that it's a discretionary decision. Companies decide that they are going to issue dividends, but they certainly don't have to. What else can companies do with profits? They can certainly keep the profits, reinvest in the business through new purchases, acquisitions. They could pay down any existing debt obligations or other liabilities that they have. Or they can sit on it and grow a pile of cash. Companies like Google doesn't distribute dividends. They just simply grow their cash balances so that they have enough ammunition to make acquisitions. So some companies have very firm, well-defined, and robust dividend policies, and this makes purchasing shares of that type of company attractive for those that want a quarterly dividend. But then other companies, and usually these are companies that are in growth mode, tend not to issue dividends and rather just use their profits and pump those profits back into the business, or at least maintain large cash reserves. We've seen this with a lot of companies like Apple and Google that sort of stockpile cash rather than giving the money back to investors so that they can continue invest in the business and grow the business. So here we see several different dividend policies for some of the companies that we've been talking about and are going to be looking at throughout this accounting exercise. We see that Huron has not declared or paid any dividends on common stock since they became a public company. The board constantly reevaluates this, and any determination to pay cash dividends will be at the discretion of the board of directors. Okay. Let's move on to Google. Google says, we've never declared or paid any cash dividend, and we intend to retain any future earnings and do not expect to pay any cash dividends in the foreseeable future. They're saying this is not a dividend company. We have growth prospects. We're not going to give the money back to investors. By the way, all these disclosures come straight from the 10K in the footnotes. Now, let's look at Apple. The company does issue some dividends. They paid a total of $10.5 billion in dividends in 2013, far more than in 2012. And this was big news when Apple started issuing big dividends. And they expect to pay quarterly dividends of $3 per common share, subject to declarations by the board of directors. So there's a significant dividend from Apple. Walmart also issues dividends. On March 1st, 2012, board of directors approved an annual dividend of $1.59 a share, which was a 9% increase over the dividends in the prior year. And we see they're listing when they're going to pay the dividend, and they're saying it's going to be paid in 4 quarterly installments of 40 cents a share, and they're listing exactly when shareholders expect to receive the dividend. In terms of dividend presentation on the income statement, common dividends are usually presented below net income and earnings per share on the income statement. And we see that here for Apple. Apple is issuing, they have earnings per share of $39.75 on a diluted basis. So looks like about 25% of their net income. I can see because 11 is around 25% of 40, represents cash distributions. These are significant. It's a significant amount of profits to be distributing out to shareholders.